Welcome to Looking at the Markets with me, David Modell. Today we're going to answer a fundamental question. What are options? Maybe you've heard about call options, put options. You might be curious to learn what they are, and you know what, even if you have experience with options, it's always good to review these things. And so this video is not just for beginners, it's really for everybody. All right. And there are other videos out there that address this question, and I've seen a lot of them, and none of them really, in my opinion, answered it the way I wanted them to. So I decided to make my own video. All right, so let's explore what options are. An option is a contract giving the contract buyer the right, but not the obligation, to buy, if it's a call option, or sell, if it's a put option, shares, and it's usually 100 shares, of an underlying asset. And the underlying asset can be a stock like Apple or Amazon or Microsoft or whatever. Or it could be an ETF or exchange traded fund. It could be a commodity. And if you don't know about exchange traded funds, don't worry about that right now. We'll just pretend that it's stocks for the sake of simplicity. We'll just talk about stocks. Now, if it's a contract giving the contract buyer the right to buy 100 shares, then it's a call option, which is also known as a call. So throughout this video, I might call it a call option or a call option contract. They all mean the same thing. It's the right to buy 100 shares of a stock or ETF or commodity or whatever. Now, if it's a contract giving the contract buyer the right to sell 100 shares, then it's a put option, which is also called a put. And again, in the video, I might call it a put option, or I might just call it a put or a put option contract. They're all names for the same thing, which is the right to sell 100 shares. These option contracts specify a particular price at which the contract buyer can buy, if it's a call, or sell, if it's a put, the underlying asset. They also specify an expiration date. You know how milk has an expiration date, or coupons have an expiration date? Yeah, so if the contract buyer wants to exercise the option, he or she would need to do so by the expiration date. So when I say exercise the option, remember, a call gives you the right to buy 100 shares of a particular stock at a particular price and by a particular date. And so you'd have to do it by the specified expiration date. And a put gives you the right to sell 100 shares at a particular price by the expiration date. Let's look at an example. We'll talk about Apple stock. Okay. For example, let's say you bought a November 18, $120 Apple call. Talking about buying one call option here for Apple. That means you would have the right to buy 100 shares of Apple stock at $120 per share at any time on or before November 18. So after November 18, your contract is finished and you don't have the right to buy 100 shares of Apple stock at $120 a share anymore. All right. Now, that means that if you bought 100 shares of Apple stock at $120, that means your total would be $12,000. Okay, and you know, obviously, if you wanted to buy it, either you'd have to have $12,000 in your trading account or investment account, or else you could have a margin account, which means you can borrow money from a broker or a bank. And if you don't understand that, that's okay. Just know that a November 18, $120 Apple call would give you the right to buy 100 shares of Apple stock if you wanted to, and you wouldn't have to, on or before November 18 for $120 a share. Now, one thing to know about option contracts is that the buyer of the contract doesn't have to exercise the contract. So if you bought one Apple call, you would have the right to buy 100 shares of Apple stock if you wanted to do that. But if you chose not to buy the 100 shares, then you wouldn't be obligated to do so. Now, the seller, which is also called the writer of the call contract, because remember, when you bought it, somebody had to sell it to you. So the seller of the call contract, on the other hand, would have an obligation to sell the 100 shares of Apple stock to you if you asked him to do so before the expiration date, which you could do by exercising the option contract. Okay, so that's if you bought the contract from him. He would have the right to sell it to you at any time. You could ask him to do it any time until the expiration date. In exchange for the burden of this obligation that the option seller has, you, the call contract buyer, would have to pay him a premium, or the price of the contract, to the call option seller. So if you're the buyer, you would pay the contract seller, the option seller, you'd pay him a little bit of money because he's taking on an obligation. Okay, you're paying a little bit of money called a premium for that right to buy the 100 shares of Apple stock before the expiration date. So let's go back to the Apple example. Let's say you bought one Apple call with an expiration date of November 18. And let's say the call option gave you the right to buy 100 shares of Apple stock at $120 per share. So again, that would be $12,000 altogether. We would then say that $120 is the strike price. Okay, so the strike price is the price at which you have the right, if you're the buyer of the option, you have the right to buy the Apple stock. Now let's also say that Apple stock is currently worth $105 per share. All right, so right now it's trading on the open stock market at $105 per share for Apple stock. And let's say that you paid $1 per share for the call option contract. Remember, that's called the premium. That's what you're paying for the right to buy the Apple stock. Now remember, one contract represents 100 shares of the stock. So that means you paid $100, or $1 times 100. You paid $100 for the call option contract. That's your premium that you paid. Now, if $100 sounds like a lot of money, consider that if you were to directly purchase 100 shares of Apple stock, it would cost you $10,500. Because remember, right now we're pretending that it's available on the open market at $105 per share. So if you bought Apple stock right now, 100 shares at $105 each, then yeah, it would cost you $10,500, which is a lot more money than the $100 premium for the call. So if you think paying for an option contract is expensive, it's very little compared to buying stock. Buying 100 shares of stock would cost you a lot more than buying one option contract. As the call buyer, you're hoping that the price of Apple, which in this case is the underlying asset, you're hoping that the price of Apple goes up in price before the expiration date. In this case, it's November 18. For example, if Apple stock went up to $130 per share by November 18. Remember, right now we're pretending that it's $105 when you bought the contract, okay? So let's say it went up to $130 by November 18, Apple stock. Then you could exercise your call contract and buy 100 shares of Apple from the call seller for a total of $12,000. Remember, it's $120 the strike price is $120. This would be great for you since 100 shares of Apple at $130 per share now would be worth $13,000 on the open market. All right, so think about it. You want, as the call buyer, you would want the price of Apple to go up a lot, and you want that to happen quickly before November 18th, the expiration date. Imagine if you bought that call option with a strike price of $120, and then imagine if Apple stock went up to $130 per share, then you could exercise your contract, and the guy who sold you the call contract would have to sell you 100 shares of Apple, and you would pay $12,000, and then you could go to the open market and turn it around and sell those 100 shares for $13,000, and you would make $1,000 profit. Okay, and you only paid $100 for that call contract, so your total profit would be $1,000 minus the $100 premium you paid, so it would be $990. No, I'm sorry, $900. You would make a $900 profit. Okay. Now, of course, you would probably pay fees and commissions, but still, you would profit pretty close to $900. That's not too bad. In fact, that's pretty good. Now, what about the seller? Well, meanwhile, whoever sold you the call would probably be unhappy. He or she, the seller of the call, would have to acquire or already have owned 100 shares of Apple, which now is worth $13,000. So if they didn't already own 100 shares of Apple stock, they'd have to go on the open market and buy it for $13,000, and then sell those 100 shares to you for a mere $12,000. And so if they had to go and buy 100 shares of Apple for $13,000 and then sell them to you for $12,000, that person would lose $1,000. Yeah, I mean, they gained $100 in premium from you, the buyer, but then they ended up losing $1,000, and so they altogether lost $900. And plus, they probably paid fees and commissions to their broker, and so they would lose a little bit more than $900, which is not fun. So you, the buyer, would be happy, and the seller would be unhappy if Apple stock went up a lot, if it went up to $130 per share before November 18. Now, what if Apple stock went down? Well, on the other hand, let's say the price of Apple didn't go up. Let's say it went down. Remember, it's $105 when you bought the contract. Let's say Apple stock went down to $90 per share. And let's say it stayed there at 90 until November 18th, the expiration date. There would be no reason for you to exercise your call contract and buy 100 shares of Apple from the call seller for $12,000. You would have no reason to exercise your call contract. After all, you could now buy 100 shares of Apple for $9,000, because remember, it went down to $90 per share. You could buy the 100 shares of Apple stock for $9,000 on the open market. So why would you exercise your call option contract and buy it for $12,000? That would be pretty silly when you can buy it on the open market for $9,000. So you'd be probably pretty unhappy if you bought that call option and Apple stock went way down to 90. What about the seller, though? Well, meanwhile, whoever sold you the call would probably be very happy. The seller would get to keep the $100 premium that you paid to him or her, and you, on the other hand, would get nothing in return for that $100. And on November 18th, your call would expire worthless. Okay, that's what it's called when things go badly for you, the call buyer, and you just let your call contract expire and November 18th comes and goes and you didn't exercise it, so it would expire worthless. Thus, call buyers pay a premium in hopes that the price of the underlying asset will go up a lot within a short period of time. Call sellers, on the other hand, collect the premium and hope that the price of the underlying asset stays below the strike price until the expiration date. Now, after the expiration date, the call seller could care less if Apple stock goes way up. After November 18th, doesn't matter. It's the opposite with puts. All right, so we talked about call options, and we used Apple calls as an example. Now, what about if you bought an Apple put, let's say? Well, it's the opposite with puts. Put option buyers pay a premium, just like call option buyers do, but put option buyers pay a premium in hopes that the price of the underlying asset will go down a lot within a short period of time. Put sellers, meanwhile, collect premium. Again, they're still collecting that premium, and they hope that the price of the underlying asset stays above the strike price until the expiration date. So it's just like the call option, it's just the opposite. So for example, let's say Apple stock is priced at $105 a share, same example. And let's say that you sell me a November 18 $90 put for $120 a share. That means that I, the buyer, would be paying you, the seller, $120 in premium. Remember, it's for 100 shares, so you'd have to multiply the per share times 100, $1.20 per share times 100, $120. That's the premium that I'd be paying you. And you would hope that Apple stays above 90. Remember, we're talking about puts here. You, the seller, would hope that Apple stays above 90, the strike price, until November 18, the expiration date. And I, the buyer, would hope that Apple quickly goes far below $90 per share. So, who has the advantage? Option buyers or option sellers? Well, it depends on whom you're asking. Option sellers enjoy the fact that they collect premium payments up front. It's an immediate credit placed in their account, so they get a little bit of money immediately as soon as the option sale goes through. They also enjoy the fact that they can profit if a stock goes sideways or just doesn't move much for a long time. Okay, so if they sell an option contract to somebody and the stock just kind of goes nowhere, it goes, stays at the same price until the expiration date, then they can make a nice profit. Option buyers enjoy the fact that they can participate in the stock market for a fraction of the price of the actual stocks. While 100 shares of a high quality stock might cost tens of thousands of dollars, you can purchase calls or puts for a few $100s or even less. So it's much more affordable. It's also worth noting that option buyers don't have to wait until the contract expiration date to make a profit. See, I might have given you the false impression that in the example with November 18 expiration, I might have given you the impression that the call buyer would have to wait until November 18th to exercise their call option. Okay. Remember, you could exercise it on November 18th or before. Okay. But there's another thing you can do. So let's talk about that. Plus, they don't have to exercise their option at all or own any shares of stock in order to profit. Okay, because you can also you can resell option contracts to other people. All right, you don't have to hold on to it. After you buy an option contract, you don't have to hold on to it. You don't have to exercise it. you can actually you can resell it to somebody else for a higher price or a lower price, but hopefully a higher price. Let's look at an example. For example, if you buy a call and the underlying asset's price quickly goes up a lot, your call contract will probably go up in value too. Okay, so the price, just like the price of stocks goes up and down, the price of the contracts, the option contracts, goes up and down with it. So you can usually sell your call to someone else before the expiration date for a profit. Similarly, if you buy a put and the underlying asset's price quickly goes down a lot, you will probably be able to sell the put contract to someone else for a profit prior to the expiration date. All right, and a lot of people do that. A lot of people buy puts and calls and they never exercise them. All right, they just buy them with the sole purpose of hoping to resell it to somebody else at a higher price, and they can, make a profit on that. One more thing to note regarding put options, is that people who already own stocks sometimes buy put option contracts because they want to protect their stocks against a big drop in price. It's almost like an insurance contract. For example, we'll go back to the Apple example. If you bought 100 shares of Apple stock, and let's say you bought it at $105 per share, and you're worried that the stock market might crash or that the Apple company might have problems, like a bad earnings report or whatever, here's what you could do. You could buy a November 18 $90 put option contract. The contract's premium would cost you some money. Remember, you have to pay a little bit of money, a premium, to buy a call or a put. But at least your Apple stock, if you bought the put, would be protected until November 18. During that time, until the expiration date, if Apple stock shares fall below $90, your losses would be contained. They would be limited because you could exercise your put option contract and sell your 100 shares of Apple at $90 per share. And you could do that even if Apple stock went down to zero, which is unlikely. But let's say Apple stock is $105 a share now, and you have 100 shares of it, so you have $10,500 worth of Apple stock. And you wanted to protect it against a market crash or whatever. And let's say the worst possible thing happened after you bought the put, right? You bought the November 18 $90 put option contract, all right? And let's say there's a horrible stock market crash, or Apple, I don't know, somehow had financial problems or a scandal or whatever, okay? And Apple stock started at 105 per share and then went down to 100 and then 95, then 90, then 80, 70, 60, 50. It's just falling and falling and falling. You'd be okay, all right? You'd lose a little bit of money because you owned it at 105, but you wouldn't lose a horrendous amount of money because you could always sell it at 90, even if it's selling on the open market at 80, 70, 60, 50, or even zero. Even if Apple stock went down to zero, until November 18th, if you own the put contract, you can sell it at 90. And so, yeah, you'd lose a little bit of money. If you bought it at 105 and sold it at 90, you would lose $15 per share, but at least you wouldn't lose like $50 per share or $80 per share or whatever. You wouldn't lose all your money. You would just lose a little bit, comparatively speaking. And so a lot of people buy puts as protection for the stock that they already have. So what's the takeaway? Well, this is only an introduction to options, and I don't recommend buying or selling options until you fully understand them and their risks, because there are risks involved. Still, I'm glad that you're taking the first step toward learning about the fascinating world of options trading and investing. And if you'd like some help with options, stocks, finance, investing, trading, whether you're a beginner or whether you're more experienced, you can call me. You can actually email me anytime. Okay. My name is David Modell, and my last name has a funny spelling, Moadel. And you can contact me by email at davidmodell@gmail.com. And if you're watching this on YouTube, I hope you learned a lot. It's just the beginning, but feel free to like the video, give it a thumbs up, leave comments. You can subscribe to me. I'm always thinking of new ideas, new educational materials because I am an educator. I've got a master's degree in education, and I'm very proud and happy to be able to share my knowledge with you. So feel free to contact me anytime. Thank you so much. I appreciate it.